They waited until the very last moment. They waited until the volumes were thin. They waited until the books were closing. And then, on the final trading day of the year, they pulled the rug. If you're looking at your screen right now, you are seeing a sea of red. You're seeing silver trading at $70.50. We have crashed down from the highs of $75. We have given back the gains of the last 48 hours. And for many investors, this feels like a betrayal. You held through the volatility. You believed in the breakout. And now, hours before the new year, your portfolio is bleeding. But I'm here to tell you that what you are witnessing is not a change in the trend. It is not a signal that silver is dead. It is a liquidity event. It is a dash for cash, and it is being driven by a specific bureaucratic rule that forces the biggest banks in the world to dump assets and hoard dollars on December 31st. In this emergency market analysis, we are going to dissect the New Year's Eve massacre. We are going to explain why gold and silver are crashing together. We are going to look at the Basel III regulations that mandate this sell-off. And we are going to explain why this crash is actually the perfect setup for the January effect. That begins in less than 48 hours. The banks are cleaning their books. They are shaking the tree one last time. Do not let them take your fruit. This is the story of the final flush. To understand why silver is dropping today, you have to understand the mind of a banker on December 31st. Today is not a trading day for them. It is an accounting day. At midnight tonight, the regulators take a snapshot of every major bank's balance sheet. This snapshot determines their capital requirements for the next year. It determines their systemic risk score, or G-SIB score. If a bank is holding too many volatile assets like silver, gold, or stocks, their score goes up. If their score goes up, they have to pay billions of dollars in extra capital reserves. So what is the logical move? Sell everything. Sell the gold, sell the silver, sell the bonds, get to cash. Cash is the only asset that lowers the risk score. So the massive red candles you see on the chart are not because Samsung stopped buying. They are not because the shortage ended. They are because JP Morgan and Citibank need to show cash on hand to the Federal Reserve tonight. They are dumping their positions into a thin market to dress the window. This is purely mechanical. It is a regulatory flush. And because the market is thin, because it is a holiday, their selling has an outsized impact. They sell 1,000 contracts and the price drops 50 cents. They sell 10,000 and it drops $2. They are forcing the price down to raise liquidity. Once the clock strikes midnight, the rule no longer applies, the pressure lifts, and the capital can flow back in. This is why we often see a V-shaped recovery in the first week of January. The banks sell on December 31st, and they buy back on January 2nd. You're watching the sell leg of the trade right now. The buy leg is coming on Friday. Let's look at the gold market. Gold is trading at $4,294. It is down $76. That is a massive move for gold. When gold sneezes, silver catches a cold. Because silver is a smaller, more volatile market, it amplifies the moves of gold. If gold is down nearly 2%, silver is down 8%. This correlation confirms that this is a macro event. It isn't just about silver supply, it is about the dollar. When banks sell assets for cash, the demand for the US dollar spikes. The dollar index is rallying today, not because the economy is strong, but because there's a shortage of dollars in the banking system to meet these year-end requirements. This dollar spike is a wrecking ball. It smashes everything priced in dollars. But remember, a liquidity crisis is temporary. The Fed knows there is a dollar shortage. They will likely inject liquidity via the repo market tonight to stabilize the banks. When that fresh liquidity hits, the dollar will fall back down, and precious metals will snap back up. We're in the eye of the liquidity storm. Now let's talk about the technical damage. A drop to $70.50 hurts the chart. It breaks the short-term uptrend. It creates a big, ugly red candle on the daily chart. Technical traders, the ones who don't understand the fundamentals, will see this and say, the trend is broken, sell. This creates a wave of follow-on selling. The algorithms see the price drop, so they short more. This pushes the price to the bottom of the range. We are currently testing the $70 support level. This is the line in the sand. We need this level to hold. If $70 holds, this entire crash was just a back test of the breakout. It is a painful but valid technical move. Old resistance becomes new support. If we bounce from here, it proves that there is a floor of real buyers waiting to scoop up the discount. And looking at the volume, we are seeing absorption. Every time the price hits $70.50, buying volume spikes, someone is stepping in front of the freight train. Someone is saying, I will take your silver at $70. That someone is the smart money preparing for 2026. Let's address the panic you're feeling. It is natural. You saw $75 yesterday. You see $70 today. You feel like you lost money, but you have to change your perspective. Did you sell yesterday? No. Are you selling today? No. Then you haven't lost anything. You still have the ounces. The market is a mechanism for transferring wealth from the impatient to the patient. Today, the market is testing your patience. It is trying to shake you out before the January rally. It is trying to get you to hand over your position to the banks who need to buy back in on Friday. Do not give them the satisfaction. Think about the end game. Does a drop to $70 change the debt ceiling? Does it change the fact that China is paying premiums? Does it change the fact that mines are empty? No. The fundamentals are rock solid. The price action is just noise. It is loud noise. It is painful noise, but it is noise. We are going to go deeper into this analysis. We need to look at the physical disconnect. While the spot price is crashing, are the dealers lowering their prices, or are they holding firm at $80? We need to look at the miner reaction. And we need to map out the strategy for the January 2nd open. Because when the banks are done selling, the vacuum reverses, and the price can go up just as fast as it came down. We are witnessing the final volatility of 2025. The storm is raging, but the ship is built for this. Hold tight. Let's pivot to the physical market reality. If you look at the screen, silver is $70.50. So you should be able to buy an American Silver Eagle for $74, right? Wrong. Go to the dealer sites right now. I'm looking at them as we speak. The premiums have expanded. Yesterday, the premium was $10. Today, it is $12 or $15. The dealers are refusing to lower their prices. Why? Because they know this crash is fake. They know it is a paper event. If a dealer sells you a coin for $74 today, and the price snaps back to $78 on Friday, they lose money. They cannot replace the inventory, so they are keeping the price high. They are pricing in the real value, not the liquidity value. This disconnect is your signal. When spot drops, but street price stays high, it means the physical supply is tight. It means there is no panic selling in the real world. Nobody's lining up at the coin shop to sell their stack. The only people selling are leveraged traders on a computer screen. You must trust the physical market over the paper market. The physical market is the truth. The paper market is the manipulation. Let's look at the industrial view. Imagine you are Tesla or Samsung. You have a budget to buy silver for January. Yesterday, it was $75. Today, it is $70.50. Are you sad? No, you are thrilled. You are issuing buy orders as fast as you can. You are using this dip to lower your average cost for the year. This industrial buying provides a hard floor. The price can only drop so far before the industrial users step in and buy everything. We believe that floor is right here at $70. Below $70, the value proposition is too good to ignore. The factories will clean out the vaults. So, while the banks are dumping paper to fix their accounting, the industry is taking the physical metal. This accelerates the shortage. It moves metal from weak hands to strong hands. Once it goes into a factory, it never comes back. We also need to consider the short squeeze reload. The banks covered some shorts earlier this week, but today, to smash the price, they likely had to reshort. They sold new contracts to drive the price down. This means they are back in the trap. They dug themselves out on Tuesday and they jumped back in on Wednesday. Come Friday, when the new capital enters, they will have to cover these new shorts. They are kicking the can, but they are kicking it uphill, and eventually the can rolls back and crushes them. The short interest is building up again. This guarantees future volatility to the upside. Every ounce they sell today is an ounce they have to buy back tomorrow at a higher price. Let's talk about the January effect mechanism again. Why does January 2nd matter so much? Because that is when the new money arrives. Pension funds, endowments, 401k contributions. Billions of dollars flow into the market on the first trading day of the year. Right now, the market is illiquid. There are no buyers. That is why the banks can push the price down so easily. But on Friday, the buyers return, the volume returns. When that wall of money hits this suppressed price, we will see a violent reversal. We could see silver jump from $70 back to $75 in one session. This is the slingshot. By pulling the price back today, they are loading the energy for the launch on Friday. Do not sell at the bottom of the slingshot. Now, I want to address the bear case. Could this be the top? Could silver go back to $50? Technically, anything is possible. But fundamentally, no. Not with the deficits we have, not with the war risk, not with the debt. A crash to $50 would require a massive deflationary depression where factories stop working and people stop eating. And if that happens, the government will print quadrillions of dollars, which sends silver to infinity. So the bear case is actually a hyperinflation case. There is no scenario where silver loses value in real terms over the long run. So how do you handle the next 24 hours? Survival. Do not look at your account balance. Do not calculate your loss from the peak. It is a paper loss. It is not real unless you sell. Focus on the ounces. Focus on the long term. Use this time to prepare for the new year. Audit your security. Check your allocations. If you have cash, get ready. If we dip below $70 momentarily, that is the buying opportunity of the quarter. Be ready to strike, be greedy when others are fearful, and right now everyone is fearful. In the next section, we are going to look at the technical levels to watch. We will map out the support at $68 and $70. We will look at the targets for the rebound, and we will discuss the tax loss harvesting that is adding to today's pressure. The massacre is almost over. The recovery is just around the corner. Hold the line. The year is ending with a fight, but we are still standing. We need to zoom in on the technical damage. When a chart prints a massive red candle like we are seeing today, it breaks the short-term structure. The momentum traders who buy breakouts, they're gone. They got stopped out. The trend followers who use moving averages, they're selling. This creates a self-fulfilling prophecy of weakness in the short term. We have broken the support at $72. We are now hanging onto the ledge at $70. Why is $70 critical? Because it was the resistance for weeks. It was the ceiling we couldn't break. Now that we are above it, it must act as the floor. If we close today below $70, it opens the door to $68. That is the next major structural support. Is a drop to $68 fatal to the bull market? No. In the grand scheme of things, a correction from $83 to $68 is a normal Fibonacci retracement. It is a 38% retracement of the entire move from $50. Technically, it is healthy, but emotionally, it is devastating. It wipes out the gains of the last 2 weeks. It makes you feel like you made a mistake, but you have to separate price from value. At $68, is silver less valuable than it was at $83? Has the utility changed? No. Has the scarcity changed? No. The only thing that changed is the liquidity premium. The market is charging you less because it has less cash to bid with. That is a discount, not a devaluation. Let's dig deeper into tax loss harvesting. This is the invisible hand pushing the market down today. Today is December 31st, the IRS deadline. If a hedge fund bought silver miners at the peak in 2021 and they are still holding them at a loss, they sell them today. Why? To book the loss, to lower their tax bill on their Nvidia gains. They don't hate the miners, they just hate taxes. This creates artificial selling. It is selling that is driven by the calendar, not the asset. And guess what happens on January 2nd? The tax year is over. The selling pressure vanishes instantly. The fund manager wakes up and says, okay, I booked the loss. Now I want the position back. So they buy. This is the wash sale dynamic. It depresses prices in December and explodes them in January. We are in the depression phase. The explosion phase is 48 hours away. Now let's talk about the miner capitulation. If you look at the GDX or SELJ ETFs today, it looks like a crime scene. Down 10%, down 12%. Investors are puking their mining stocks. They are saying, if silver can drop $8 in a day, the miners are risky. This is fear speaking. Look at the cash flow. Even at $70, these companies are cash flow monsters. But the market isn't pricing them on cash flow today. It is pricing them on liquidity. Miners are a high beta asset. They are the tail of the dog. When the dog gets whipped around, the tail snaps violently. But this snap creates the opportunity of a lifetime. We are seeing high-quality producers trading at valuations that imply silver is $30. The market has disconnected from reality. If you have cash, this is where you look. You buy the miners when there is blood in the streets, and today there is a lot of blood. Let's pivot to the macro context. The bond market. The 10-year Treasury yield spiked today. Why? Because banks are selling bonds to raise cash, just like they are selling silver. When yields go up, it tightens financial conditions. It hurts the stock market. It creates a risk-off environment. But here's the catch. The U.S. government cannot afford higher yields. With $36 trillion in debt, every 1% rise in rates costs the government hundreds of billions in interest. So, the higher rates go today, the more likely the Fed is to intervene tomorrow. The bond market crash guarantees the next round of money printing. They have to print to save the Treasury. And when they print, silver flies. So, this crash in bonds is actually the precursor to the next leg up in precious metals. It forces the Fed's hand. We are watching the system break so that the Fed can fix it with inflation. You own the inflation hedge. You are positioned for the fix, not the break. Let's look at the January 2nd setup. The markets are closed tomorrow for New Year's Day. This gives everyone 24 hours to cool off, to think, to calculate. When they come back on Friday, they will see silver at $70. They will see gold at $4,300. And they will see a world that is still short of resources. The bargain hunters will be waiting at the open. The pension funds will be waiting. The industrial hedgers will be waiting. The sell pressure from the G-SIB rule and tax harvesting will be gone. This creates a vacuum up. Just like we fell into an air pocket today, we can rise into an air pocket on Friday. The liquidity will be low, but the buying pressure will be new. So do not be surprised if we see a limit up open on Friday morning. The market has a way of hurting the most people possible. It hurt the longs today by crashing. It will hurt the shorts on Friday by ripping. The whipsaw is designed to clear the board. Now, a word on physical delivery for January. First notice day has passed. The longs who stood for delivery are now waiting for their warrants. With the price crashing, you might think they would walk away, but they aren't. The open interest in the delivery month is staying high. This means the buyers want the metal. They are not scared by the price drop. They are happy to take delivery at $70 instead of $79. This confirms the physical shortage. If the buyers were speculators, they would have fled. The fact that they are staying proves they are industrial users who need the atoms. The drain on the vaults continues. Today's price action is a paper storm. The physical foundation is unmoved. Let's talk about emotional capital. You have financial capital and emotional capital. Today, you spent a lot of emotional capital. It is exhausting to watch your net worth drop. But you have to recharge. Turn off the screen. Stop watching the red candles. Go celebrate the new year. You cannot change the price by staring at it. You have to trust your thesis. Why did you buy silver? Did you buy it for a quick flip? Or did you buy it because the fiat system is mathematically doomed? If the fiat system is still doomed, then the trade is still on. The timeline might have shifted. The path might be bumpier. But the destination is the same. Do not let a one-day liquidity event shake you out of a generational position. We are going to wrap up this section with a look at the global perspective. While New York is selling, what is Shanghai doing? We don't have the live data yet, but typically, China buys the dip. When the West sells gold and silver, the East buys it. We are likely seeing a massive transfer of physical metal from Western vaults to Eastern vaults right now. The price drop facilitates this transfer. It makes it cheaper for China to drain the COMEX. We are subsidizing our own demise. History will look back at this day as the day the West gave away its last strategic reserves for pennies on the dollar. In the next section, we will look at the recovery roadmap. What does the chart look like from here? How long until we reclaim $75? We will look at the V-shaped probability, and we will give you the final checklist for the new year. The massacre is painful, but it is over. The recovery begins in 48 hours. Stay tuned. We are finding the light. We need to map out the recovery. The market has taken a punch to the gut. The wind has been knocked out of it. But markets, like fighters, have resilience. So what does the recovery look like? Is it a slow grind, or is it a violent snapback? Based on the mechanics of this crash, the G-SIB rule, the tax selling, the thin liquidity, the recovery is likely to be V-shaped. Why? Because the selling was event-driven, not value-driven. The sellers didn't sell because silver is worthless. They sold because the calendar said December 31st. Once the calendar says January 2nd, the reason to sell disappears. This creates a vacuum. The sellers leave the market, the buyers return, and the price has to move up to find liquidity. We could see silver reclaim $73 by Friday close. We could be back at $75 by next Monday. The speed of the recovery will match the speed of the crash. Let's look at the January effect targets again. With the price now reset to $70, the upside potential for January is even bigger. If the pension funds enter at 70, they can drive it to 85 without it looking like a bubble. This reset extends the runway of the bull market. It gives us more room to run before we hit euphoria. So, in a strange way, this crash saved the rally. It prevented a blow-off top that would have ended the cycle too early. Now, let's talk about the short sellers who made money today. They are sitting on profits, but they know the game. They know about the January effect. They know that staying short into the new year is suicide, so they will likely become buyers on Friday. They will cover into weakness. They will buy back their shorts to lock in the profit. This adds buying pressure to the market. Short covering is the most reliable source of demand after a crash. It puts a floor under the price because the shorts must buy to exit. Let's look at the macro data coming out next week. First week of the month, we have manufacturing PMI. We have jobs data. If the data is weak, the market will sniff out a recession. Recession means Fed pivot. Fed pivot means lower rates. Lower rates mean higher silver. If the data is strong, the market will sniff out inflation. Inflation means higher commodities. Higher commodities mean higher silver. This is the win-win setup we talked about. Whether the economy booms or busts, silver wins. The only thing that kills silver is stability. And does the world look stable to you? No. We need to address the physical dealers one more time. If you're thinking about buying physical silver, this dip is your window, but you have to be fast. The dealers are watching the same chart. If they see the price bouncing on Friday, they will raise their premiums again. The discount window might only be open for 24 hours. If you have cash, now is the time to deploy it. Call your dealer. Check the inventory. Even if the premium is high, $70 silver is cheaper than $80 silver. You are buying the dip in the base price. Let's look at the gold to silver ratio. with silver down 8% and gold down 3%. The ratio has widened. It went from under 60 to over 62. This makes silver cheaper relative to gold than it was yesterday. This attracts the ratio traders. They will sell their gold to buy silver. They see the ratio blowing out, and they bet on it compressing back down. This arbitrage provides support for silver. It prevents the price from free falling. The gold market acts as a parachute. Now, let's talk about market sentiment. I read the comments. I see the fear. It's rigged. They will never let it rise. This anger is a signal. It is a sign of capitulation. When the retail investor gives up, when they throw their hands in the air and say the game is rigged, that is usually the bottom. The market has successfully washed out the optimism. Now it can climb the wall of worry. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Today, we went back to pessimism. That means the bull market has been reborn. Let's look at the Commitment of Traders report. Next week's report will likely show a massive reduction in the commercial short position. The banks used this crash to cover. They reduced their liability. This means they have less incentive to smash the price next week. They have de-risked. With the banks less short, the path of least resistance is up. The suppression pressure has been vented. We also need to consider the technical damage repair. How long does it take to fix a broken chart? Usually, we need a few days of consolidation, sideways trading. Expect silver to chop between $70 and $72 for a few days. This is base building. It allows the moving averages to catch up. It allows the traders to calm down. Do not get frustrated by sideways action. Sideways is the bridge between down and up. It is necessary. Let's look at the global liquidity cycle. The central banks of the world are easing. China is cutting rates. Europe is cutting rates. The global money supply is expanding. This liquidity finds its way into assets. It flows like water. It fills every crack. Right now it is flowing out of silver because of the year-end squeeze. But in January, the tide turns. The liquidity flows back in. The global M2 money supply chart is the only chart that matters in the long run. And that chart is going up and to the right. Silver will track it. It has no choice. So, as we prepare to close out the year, remember the big picture. You are holding a strategic asset in a world that is running out of resources. You are holding real money in a world of fake currency. The price dropped today, but the value did not. The value is intrinsic. It is chemical. It is historical. $70 is just a number on a screen. The ounce in your hand is the reality. In the final section of this broadcast, we will wrap up with the final strategy. I will give you the specific price levels to watch on Friday morning. I will tell you how to position your portfolio for the January open, and I will leave you with the final verdict on why this crash is the best thing that happened to us all year. It gave us a reset, it gave us a discount, and it gave us a launch pad. The massacre is over. The recovery is loading. We have reached the final chapter of this market alert. We have dissected the regulatory flush that drove silver down to $70.50. We have analyzed the contagion from the bond market and the panic selling by the hedge funds. We have looked at the physical dealers holding the line on premiums. Now you are left with a portfolio that is battered but not broken. You're standing at the finish line of 2025. It has been a historic year, a year of breakouts, a year of awakening, and it is ending with a test of your conviction. In this final breakdown, part 4, I'm going to give you the January 2nd battle plan. I'm going to tell you exactly what to expect when the markets reopen on Friday morning. I am going to give you the physical buy signal, the specific price and premium combination that tells you it is time to back up the truck. And I'm going to leave you with the final verdict on why this crash is the fuel for the rocket that launches in 2026. The banks fired their last shot of the year. They missed the heart, and now the bull is angry. Let's finish this. Tomorrow is New Year's Day. The markets are closed, the computers are off, the bankers are hungover. It is a day of silence. Use this silence to prepare. Because on Friday morning, January 2nd, at 8 a.m. Eastern Time, the bell rings, and the January effect begins. What happens at the open? Based on the violence of today's selling, the market is oversold. The rubber band is stretched to the downside. When the new capital from the pension funds hits the market on Friday morning, it will meet an empty order book. The sellers have already sold. They sold today. They are gone. So the buyers will have to chase the price up. I expect to see a gap up on Friday morning. We could open at $71 or $72. We could erase half of today's losses in the first hour of trading. This is the slingshot effect. The G-SIB rule forced the price down. The expiration of that rule allows it to snap back. If you are a trader, this is your opportunity. If you are an investor, this is your confirmation. Watch the open. If we gap up on high volume, the crash is officially over. The bottom is in. Now let's talk about the physical metal one last time. Today, silver is on sale. Spot price is down 8%, but premiums are high. So when do you buy? You buy when the panic subsides, but the price lags. Usually, this happens about 24 hours after a crash. Dealers are currently paralyzed. They hiked premiums because they were scared. By Friday, they will calm down. They might lower premiums slightly to attract business. If you can buy silver at $75, all-in price, while spot is recovering, that is a steal. You are buying an asset that was trading at $83 just yesterday. You're getting a 10% discount on the future. Do not try to time the absolute bottom. You will miss it. If you see metal available and the price is lower than it was on Monday, take it. The window of opportunity will close as soon as the institutional buying starts next week. When the big funds start buying, the physical inventory will vanish again, and the premiums will go back to the moon. Let's lift our eyes to the horizon. 2026? This is the year the rubber meets the road. The deficits are cumulative. We have drained the vaults for 5 years straight. We are entering the 6th year of deficit. Mathematically, this is the year the warehouse hits zero. When that happens, the price mechanism changes. It stops being driven by speculation and starts being driven by scarcity. Scarcity pricing is exponential. It doesn't go up 10%, it goes up 100%, it goes until it destroys demand. We are looking at a year where silver could touch $150. It sounds crazy today, staring at a red chart. But remember, oil went from negative $40 to $120 in 2 years. Commodities move fast when the shortage hits. So do not let today's price action cloud your vision of next year's reality. The debt is still there. The solar panels are still being built. The missiles are still being fired. The fundamental drivers of the bull market are stronger today than they were yesterday. Because today, the price is cheaper. A lower price with the same fundamentals equals a better investment. So here's the verdict on the year-end massacre. It was a rigged game. It was a regulatory flush designed to save the banks from capital charges. It had nothing to do with the value of silver. It had everything to do with the mechanics of the banking system. You survived it. You held the line. You didn't panic sell. You proved that you are a strong hand. Now, enjoy your new year. Celebrate the fact that you own the only asset that is outside the system. You own the money of the people. You own the energy of the future. When the sun rises on 2026, the game restarts, the score is reset, and the silver market is ready to run. You were early, you were right, you are ready. Welcome to the year of the squeeze. Subscribe.